This video will begin by introducing types of banks, services each bank type provides, and segment of population it focuses to serve. Next, it introduces Fintech, what Fintech is, a brief history and typical services it provides. Using various studies conducted by different bodies, a summary and conclusion is presented to understand what population looks for from financial services, covering population from both urban and rural settings. This video will end by sharing some examples how Fintech solutions has had far-reaching implications to governments and the general public's life, more than anyone would have predicted or expected.
Banks come in different varieties, each with its own specialty. Some are all about the everyday Joe, while others cater to mega corporations. We're going to break down these different types of banks, from the big dogs at the top to the community players holding it down locally.
They control the money supply, set interest rates, and basically keep the entire economy from going off the rails. In the US, we've got the Federal Reserve, aka the Fed. They're like the financial superheroes, or villains, depending on who you ask. Remember the 2008 financial crisis? Yeah, the Fed was there, throwing money at the problem like it was going out of style. Central banks are all about the big picture. They're not concerned with your everyday checking account. They're focused on keeping the entire system afloat.
2. When you picture a bank, a retail bank probably comes to mind. Retail banks offer members of the general public financial products and services such as bank accounts, loans, credit cards, and insurance. In some cases, they can set up checking accounts and make loans for small-scale businesses as well. Retail banks can be traditional, brick-and-mortar brands that customers can access in person, ATM machines, or online, through their mobile phones or PCs. To keep up with changing times and customer preference, many now provide services through web-based platforms. Customers can access their accounts, make payments, apply for loans, and manage their finances online without visiting a bank branch. Some have extended their services by incorporating payment processing, usually using QR code, for both in-store and online purchases. 3. Commercial banks tend to concentrate on supporting medium-sized businesses. Businesses can turn to commercial banks for deposits, open a checking or savings account, or borrow money, get access to credit, or transfer funds to companies in foreign markets. They generate revenue primarily through interest on loans and fees for services. Their customers can include individuals looking for personal banking services like checking and savings accounts, personal loans, and credit cards. And small to medium-sized businesses, SMEs, that need business accounts, business loans, lines of credit, and merchant services. 4. Corporate banks tend to concentrate on supporting large-sized businesses, especially public-listed corporations. Large corporations can turn to corporate banks if they need to open a checking or savings account, borrow money, get access to credit, or transfer funds to companies in foreign markets. Corporate banks tend to have extensive lending and capital markets or investment capacity compared to commercial banks by being able to provide syndicated loans through bonds, financial institutions, or other private lenders, e.g. private equity, pension plans, etc. They generate revenue primarily through interest on loans and fees for services. 5. Investment banks specialize in providing services related to financial markets, such as underwriting, facilitating mergers and acquisitions, and acting as intermediaries between securities issuers and investors. They do not accept deposits like commercial or retail banks. They provide consultancy to country, corporations, or individuals who need financial advisory for mergers, acquisitions, and corporate restructuring. Investment banks assist companies in raising capital by underwriting and issuing stocks, equity, and bonds, debt. They also provide managing investment portfolio services or raising money for certain businesses and the government. 6. Cooperative banks, or simply known as co-banks. They can be either retail banks or commercial banks, but in much smaller scale and focus on specific area of customer needs. What distinguishes them from other entities in the financial system is the fact that they are typically local or community-based associations whose members help determine how the business is operated. They are usually run democratically and they offer loans and bank accounts, among other things, to its members. They are popular in countries throughout the world and are used primarily by small family-run businesses or retired civil workers. Some examples, but not limited to, are unions, armed forces, farmers, construction, village industries, and more.
A modern customer refers to individuals who have contemporary expectations and behaviors shaped by advancements in technology, changing lifestyles, and evolving consumer demands. What do modern customers look for from financial services? Many studies have been done across both developing and developed countries to answer this question, and let me share with you some common points from the findings. Points that were specific to country environment were purposely excluded to keep this informative video objective. Modern customers have evolving expectations from financial services. It is mainly driven by technological advancements, changing lifestyles, and a desire for convenience and personalized service. They are redefining their expectations, taking their cues from other industries that offer multi-channel access, product simplicity, mobility, cross-border availability, seamless accessibility, personalization of services, integrated experience, 24/7 service, and on-demand education. They expect constant innovation, community engagement, and segment of one targeting that fits their digital lifestyle. They don't mind to trade their personal data usage for tailored offerings through analytics, but they demand transparency and clear communication about how their data is used, and the security protocols in place to protect it is absolutely mandatory and not open for negotiation. Here's what they typically look for. 1. Digital and mobile transaction that is convenient and intuitive to use. They want the ability to manage their finances on the go. Mobile financial service apps that offer easy access to accounts, seamless transactions, and real-time notifications. The interface must be smooth and intuitive to use. They want menus that are personalized. They want clean menus that don't require countless clicks or tons of taps to access basic financial service tasks. They want an industry standard to a mobile interface. They don't want to have to relearn on a different desktop or tablet display. 2. Modern customers expect personalization. They appreciate use of data analytics to offer personalized financial advice, products, and services based on their spending habits, income, and life stage. They demand customized offers, from personalized loan options to savings plans, investment options, and more. They want to feel like their financial service provider is anticipating their needs, not bombarding them with product offerings. Customers want individual attention and relevant offers from their financial service provider, and not the usual spam of generic ads. Customers want to be understood so much that they are perfectly willing to trade personal data for tailored offerings. 3. Modern customers expect data protection from cyber threats. They expect demonstration of strong security measures being taken to protect their information. They will not think twice to change if they feel their concerns are not taken seriously. They demand transparency and clear communication about how their data is used, and the security protocols in place to protect it is highly valued. 4. Payments and transfers must be instant with almost instant notifications. If they apply for loan, they expect near instant response regardless is approved or not. Scheduled and personalized features like automatic payments, recurring transfers are highly sought after for their efficiency. 5. Modern customers expect and demand transparency and trust through clear and timely communication. They hate surprises like hidden fees, interest rates, and terms of service. They place a high value on trust and reliability for long-term financial security. 6. Financial education and advisory services, or robo-advisor, where data is constantly updated and uses latest technology like machine learning or artificial intelligence and must be available on demand 24/7. They expect easy-to-use interface that is also audio-enabled to post questions on broad subjects related to financial product and services they have signed up for, and they expect a detailed and concise answer that leaves no room for doubt. 7. They want to be proud being part of a provider that demonstrates commitment to environmental sustainability and ethical practices. They want more products geared towards environment, like loans geared towards business that are involved in environment. Innovation must go beyond yesterday's mantra. 8. Naturally, the provider that provides with lowest fee and provides what a modern customers looks for wins. It's that simple. They are sensitive to fees and will apps that compare different providers to find the best provider. They expect any reward or loyalty programs to be more than what it was yesterday, but is more innovative and personal in its approach. Yesterday's cashback offers, reward points, and other incentives are attractive, but they expect more than that. 9. They continuously expect innovation and use of cutting-edge technology. Facial and voice recognition, thumbprints, historical use patterns, machine learning, artificial intelligence should already be used today. 10. They expect community-based forums as part of support and engagement process. They want to be engaged with other customers to share experiences, be it positive or grouses, to vet and support business loan applicants, provide recommendations, and more. 11. Flexible and personalized loan terms based on historical use. If they have been loyal long-term users, they expect flexible repayment options during rainy days and personalized loan products. They expect innovative and flexible savings plans that can be personalized with their financial plans and goals. Companies must go beyond personalization and build great, high-value financial offerings that attracts today's savvy financial service customers. Customers want convenience and value, and they are willing to exchange their personal data for good deals and discounts.
What rural customers look for. Whether they are the unbanked population in rural areas or already banked population in rural areas of developing countries. Both these groups have similar needs and desires when it comes to financial services. The rural population of developing countries desires financial services that are accessible, affordable, and trustworthy. They seek simple, not discriminative and user-friendly solutions that cater to their specific needs, including low-cost savings and credit options, secure money transfers, and insurance products tailored to their realities. Trust, community-based support, and cultural sensitivity are also crucial in encouraging adoption and usage of these financial services. Here's what they typically look for. 1. Even if they are banked, rural populations typically look for financial services that are easily accessible, considering the physical distance from bank branches and transport cost, availability, and time to commute. 2. Cost-effective services are essential, as many rural customers have lower incomes and irregular cash flows. They don't expect vast availability of products and services as their peers in urban setting. They naturally prefer low fees and services that don't require maintaining high minimum balances. Minimum balance requirements can deter usage. 3. Services that doesn't require the need for time and cost to travel to physical locations or use of agents with fees. As most of them are farmers or odd workers, they value time and money and prefer not to waste on traveling for basic banking needs. Services such as mobile banking, e-payments, e-transfers, e-remittance and e-loans are highly sought after. 4. Many rural populations are engaged in farming or other small and odd businesses. They need credit products tailored to their lifestyle. For example, a farmer will follow the agricultural cycle. A small business food caterer would follow the marriage season cycle. They need access to small, short-term loans with reasonable interest rates to invest in tools, seeds, livestock, inventory, or cover emergencies. They look for small loans with flexible repayment terms aligned with their harvests or business needs. 5. They seek simple savings options that allow for small, irregular deposits without penalties, helping them to build a financial cushion over time. They prefer simple and secure savings accounts that allow them to save small amounts over time. They might save for their children's weddings or fixing that leaking roof in their house. These might seem small matter for urban population but is very important to rural population. Interest-bearing accounts that help them grow their savings are especially valued. 6. Due to limited literacy or familiarity with complex financial products compared to urban population, rural population obviously needs services that are simple to understand and easy to use, with minimal paperwork and straightforward instructions. 7. It is not uncommon that rural population may lack formal identification documents, making it hard to open traditional bank accounts. They want financial services that do not require strict national-level identification papers and physical thumbprint or signature. KYC or Know Your Customer process using any alternative IDs like Community Verification Card, Farming ID coupled with biometric registration is most welcome. They are just looking for services to cater to their basic financial needs without discrimination. 8. With limited access to physical banks, mobile phones become a critical tool for accessing financial services. They want mobile phone banking solutions that allow them to conduct transactions, save, and borrow money. 9. They are looking for affordable micro-insurance products that cover common risks like health emergencies, crop failures due to bad weather, or death of a family member, which can otherwise lead to financial disaster. 10. Many rural families rely on remittances from relatives working in cities or abroad. They need secure, low-cost, and fast money transfer services. They often look for ways to send and receive small amounts of money with friends, family, and local businesses efficiently and affordably. 11. For the more religious rural population, they prefer financial products and services that align with their cultural practices and beliefs, such as Sharia-compliant banking in predominantly Muslim areas.
In the simplest terms, Fintech, short for financial technology, represents the integration of technology into financial services. From mobile banking to online lending, Fintech is transforming the way we manage our money, invest our savings, and interact with the financial world. By leveraging the power of technology, Fintech is breaking down traditional barriers, democratizing access to financial services, and empowering individuals and businesses alike. The beauty of Fintech lies in its ability to adapt and evolve to meet the changing needs of consumers and businesses. As technology continues to advance, we can expect to see even more innovative Fintech solutions emerging, further shaping the future of finance. This evolution promises a future where financial services are more personalized, accessible, and seamlessly integrated into our daily lives.
Fintech is a broad term that encompasses a wide range of services. Let's explore some key examples that illustrate the transformative power of Fintech mobile banking. Remember the days of queuing at the bank? Mobile banking has made those a distant memory. With just a few taps on our smartphones, we can check balances, transfer funds, and pay bills from anywhere, anytime. Peer-to-peer lending (P2P) lending platforms connect borrowers directly with lenders, cutting out the traditional intermediary, the bank. Cryptocurrency. Bitcoin, Ethereum, and other cryptocurrencies are digital currencies that use cryptography for security. Robo-advisors. These automated investment platforms use algorithms to provide personalized investment advice and portfolio management.
The rise of fintech has had a profound impact on the financial industry, ushering in a new era of accessibility and efficiency. Fintech reaches the unbanked and underbanked populations, offering alternative financial services that are more inclusive and accessible. Automated processes and real-time data analysis streamline operations and improve customer experience.
A history of innovation, from humble beginnings to a global phenomenon. Fintech's roots trace back to the late 19th century with the first transatlantic cable. Milestones like credit cards, ATMs, and electronic stock trading paved the way for digital finance. The first online banking services in the 1990s marked the internet era in finance. Post-2008 crisis, new fintech startups emerged, offering innovative solutions to financial challenges.
Section 5. The Rise of Fintech. Navigating the 2008 financial crisis and beyond. The 2008 financial crisis eroded public trust in traditional financial institutions. This, coupled with the increasing availability of smartphones and the rise of cloud computing, created the perfect storm for fintech to flourish. Consumers, disillusioned with traditional banks, were more open to exploring alternative financial services offered by fintech companies. These companies, often more agile and innovative than their traditional counterparts, were able to capitalize on the changing landscape and attract a new generation of tech-savvy customers. The post-crisis regulatory environment, while more stringent, also played a role in fostering fintech innovation. This period saw a surge in investment in fintech companies, as venture capitalists and other investors poured billions of dollars into this burgeoning sector.
Section 6. Fintech in a post-pandemic world. A catalyst for change. The COVID-19 pandemic further accelerated the adoption of fintech solutions. Lockdowns and social distancing measures forced consumers and businesses to turn to digital channels for their financial needs, leading to an unprecedented surge in demand for online banking, mobile payments, and other fintech services. The pandemic also highlighted the importance of financial resilience and inclusion. Fintech companies played a crucial role in facilitating government aid disbursements, providing access to credit for small businesses, and enabling contactless payments. With advancements in artificial intelligence, blockchain technology, and other emerging technologies, we can expect to see even more disruptive innovations in the years to come. The future of finance is undeniably intertwined with the evolution of fintech, and the journey is only just beginning. In many parts of the developing world, a financial revolution is underway. This revolution is powered by fintech, a dynamic blend of finance and technology. Fintech is growing at an electrifying pace in these regions, offering new opportunities and transforming lives. From mobile money to microloans, fintech is breaking down barriers and driving financial inclusion.
Traditional banks have often struggled to reach rural, often illiterate and poverty-stricken populations in developing countries. Physical branches are expensive to build and maintain, particularly in remote areas. While PayPal, Google Pay and Apple Pay are available, they still required linking to traditional banks' accounts for daily transactions, and the fees are too high for the poorer segment of the population. This is where fintech steps in, offering a lifeline to the rural population, both the already banked and the unbanked, increasing financial inclusion. Mobile banking apps, for example, has dramatically transformed the financial landscape for rural populations. It allows users to manage their finances, transfer money, access credit using alternative credit scoring models, and allows for savings without ever setting foot in a bank with the use of electronic wallet, and most importantly, the fees were very low. Fintech is empowering individuals, especially women, to economically participate in local and broader markets, and build financial resilience. Fintech has played a transformative role in improving the delivery of aid to the abject poor, especially in areas where traditional methods have been inefficient or inaccessible. The affordability of technology that are essential for fintech growth and long-term sustainability is a key driver of fintech's success in developing countries. Smartphones and internet access are becoming increasingly common, even in low-income communities. This widespread connectivity creates a fertile ground for fintech startups to develop and deploy innovative solutions at a fraction of the cost of traditional financial institutions. Recognizing fintech's potential, many developing countries have established regulatory sandboxes. These sandboxes are controlled environments where fintech companies can test new products and services without being immediately subject to full regulatory requirements. This allows for experimentation and innovation, fostering an environment where fintech can flourish. Mobile money takes center stage. A phone in every pocket means potentially an electronic wallet in every pocket. The high penetration of mobile phones in developing countries has been a game changer for fintech. Mobile money platforms, like M-Pesa in Kenya, have become ubiquitous, allowing millions to send and receive money, pay bills, and access financial services using their phones. This has been particularly transformative for those without access to traditional banking. Fintech in Kenya has reduced the need for intermediaries, ensuring that more aid reaches the intended recipients. Programs like Kenya's Hunger Safety Net program uses mobile transfers to provide regular cash payments to its most vulnerable populations. By delivering aid directly to recipients via digital platforms, fintech reduces the risk of funds being siphoned off by corrupt intermediaries or lost in bureaucratic processes. Digital platforms can track compliance, leveraging data analytics to better target aid to those most in need. By analyzing transaction histories, mobile phone usage, and other data, aid organizations can identify the poorest households and direct resources accordingly and ensure aid is used as intended. Fintech platforms provide real-time tracking of aid disbursements, allowing donors and GOs to monitor where funds are going and ensuring that they reach the intended recipients. This transparency builds trust in aid programs and reduces the likelihood of fraud. Digital transactions create a clear audit trail, making it easier to audit aid programs and ensure that funds are used appropriately. Aid can be customized based on the needs of the recipient. Fintech platforms allow aid to be distributed in multiple forms, including digital vouchers, prepaid cards, or mobile money. Recipients can use these funds to purchase food, pay for healthcare, or cover other basic needs. Governments as catalysts, fostering a fintech-friendly environment. Governments across the developing world are increasingly recognizing the importance of fostering a thriving fintech ecosystem. This includes initiatives to improve financial literacy, invest in digital infrastructure, and create favorable regulatory frameworks. By creating an enabling environment, governments can unlock the full potential of fintech to drive economic growth and social progress. More governments are simplifying business registration and reducing bureaucratic hurdles to make it easier for fintech startups to set up and operate. Some are providing tax incentives or breaks for fintech startups to reduce the financial burden on new companies, allowing them to reinvest in growth and innovation. Few offer grants, low-interest loans, or other forms of financial support to fintech startups, especially those that address critical social needs like financial inclusion or support small and medium-sized enterprises, SMEs. Some governments go further to mandate open banking initiatives, requiring traditional banks to share customer data with fintech companies with customer consent through standardized APIs. This fosters competition and innovation in both traditional banks and fintech companies to improve their services.
Case studies. Fintech trailblazers around the world. China is home to giants like Ant Financial, also known as Alipay, and Tencent, which operates WeChat Pay. The country has witnessed an explosion in mobile payments and digital financial services. The government's push for a cashless society has further fueled this growth. WeChat is a super app because it combines a wide range of functionalities into one platform, offering users an integrated omni-channel, digital access experience that spans social networking similar to WhatsApp, e-commerce and online services. Similar to eBay, it offers games, payment and financial services, health and government services, business and productivity tools, and finally entertainment and media. Its ability to serve as an all-in-one app for nearly every aspect of daily life has made it indispensable in China and a model for super apps globally. In India, with its massive population and a government-led push for financial inclusion, the country has emerged as a hotbed for fintech innovation. Companies like Paytm and PhonePe have gained millions of users, revolutionizing digital payments. India and China are going global with fintech. India with its Unified Payments Interface, UPI, and China with its UnionPay. UPI and UnionPay e-wallets are both digital payment platforms, but they have distinct characteristics and operate in different contexts, addressing different needs and objectives. UPI e-wallet is primarily a mobile-based payment system in India. It leverages the UPI infrastructure to enable instant fund transfers between bank accounts using mobile numbers or virtual payment addresses (VPAs). UPI is highly interoperable, with focus on remittances from banks abroad. UPI is a mobile-based, real-time payment system designed to facilitate instant bank-to-bank transfers and digital payments in India. UnionPay e-wallet is a digital payment platform offered by China's UnionPay. It primarily operates with debit and credit cards, similar to Visa or MasterCard, but also supports mobile payments through recently launched UnionPay QuickPass. UnionPay's focus is on international acceptance of payments. To detail the difference between both UPI and UnionPay is complex and deserves a separate video.
Kenya is a pioneer in mobile money, with M-Pesa becoming a model for financial inclusion globally. Before the advent of fintech, a large portion of Kenya's population was unbanked, particularly in rural areas. Mobile money platforms like M-Pesa have brought financial services to millions of people who were previously excluded from the formal banking system. A study by MIT found that between 2008 and 2014, M-Pesa lifted 194,000 households out of extreme poverty. The same MIT study found that women in households with access to M-Pesa were more likely to shift from subsistence farming to business or retail, increasing their incomes and economic independence. As of 2022, about 83% of the adult population in Kenya was using mobile money services. M-Pesa allows users to send and receive money, pay bills, and even access microloans using their mobile phones. The widespread adoption of mobile money in Kenya has facilitated increased economic activity by making it easier for individuals and businesses to send, receive, and manage money. This has boosted commerce, particularly in the informal sector, which makes up a significant portion of Kenya's economy. Fintech has empowered entrepreneurs and small and medium-sized enterprises, SMEs, by providing them with access to financial services that were previously unavailable or too expensive. M-Shwari and Tala uses alternative credit scoring models, such as mobile phone usage data, to offer loans to people who lack traditional credit histories. M-Shwari allows users to save money directly through their mobile phones, earning interest on their savings. This has helped promote a culture of saving. The Kenyan government was able to increase its tax revenue after able to track transactions, boosting public revenue. The government has also adopted fintech solutions for delivery of public services. For example, citizens can pay for government services, such as business permits or utility bills, using mobile money. This has reduced corruption and improved the efficiency of service delivery. The Health Ministry uses mobile platforms to deliver health education or collect data in rural areas. Kenya's fintech success has attracted significant foreign investment into the sector, further fueling innovation and economic development. Mobile money and digital loans have enabled businesses to start, expand, and improve their operations, contributing to job creation and economic growth. Nairobi is now referred to as Silicon Savannah, has become a hub for tech startups and fintech companies. Indonesia had a large unbanked population, especially in rural and remote areas, spread across its many islands. Fintech has significantly improved financial inclusion by providing digital banking and mobile payment solutions to people who previously lacked access to formal financial services. Companies like Gojek and Ovo are leveraging the country's high mobile penetration to offer a range of financial services. Mobile wallets from GoPay, from Gojek, and OVO have become widely used across Indonesia, allowing even those without traditional bank accounts to participate in the digital economy. This has been particularly impactful to younger populations who migrated to urban areas. P2P lending platforms like Invs, Tree, and CoinWorks have provided an alternative to traditional bank loans, offering credit to individuals and SMEs who might not qualify for conventional banking services. Indonesia's economy heavily relies on SMEs, which make up a large portion of the country's businesses. Fintech has provided SMEs with access to digital payments and financing options, enabling them to grow, reach new markets, and manage their finances more efficiently. Indonesian government has increased its revenue, since able to track transactions more effectively and efficiently, and offers fintech platform for its citizens to pay taxes and other services. Similar to other poor developing countries, rural population had to previously depend on mobile banking and agent networks. People in these regions can now save money, receive payments, and access credit, without traveling long distances to the nearest bank. Fintech has facilitated the rise of the gig economy in Indonesia, providing payment solutions for freelancers, ride-hailing drivers, and other gig workers. Platforms like Gojek and Grab have integrated fintech services, allowing workers to receive payments instantly, manage their finances, and even access microloans. The rapid growth of the fintech sector has created numerous jobs in areas such as software development, data analysis, customer service, and financial consulting. This has contributed to employment opportunities, particularly in urban centers like Jakarta, and a rise in the middle income group. Women entrepreneurs, in particular, have benefited from easier access to credit and payment solutions, enabling them to grow their businesses and achieve greater economic independence. During the COVID-19 pandemic, Fintech platforms were used to distribute government aid, disaster relief, and social welfare payments to millions of Indonesians, ensuring that assistance reached those in need quickly and securely. Many fintech companies here run educational campaigns to teach people about managing finances, using digital payments, understanding credit, and about health insurance schemes. Fintech has also strengthened social networks by making it easier for people to support each other financially, whether through remittances, group savings, or crowdfunding initiatives. In Nigeria, we are seeing a surge in fintech startups addressing various needs, from payments and lending to insurance and wealth management. Like Kenya, mobile money platforms like Paga, Opay, and Kuda have become increasingly popular, allowing individuals to send and receive money, pay bills, and access other financial services without the need for a traditional bank account. This has been particularly impactful in urban and peripheral urban areas. Using alternative credit scoring methods, fintech platforms are offering microloans and short-term credit to individuals and businesses. Agriculture is a significant part of Nigeria's economy, and fintech has helped farmers to access financing and insurance products. Platforms like Farm Crowdy allow small farmers to crowdfund their operations, while others provide microloans and weather-indexed insurance, reducing risks associated with farming. SMEs are the backbone of Nigeria's economy, and fintech has provided them with the tools to grow and compete. Digital payments, access to credit through alternative lending platforms, and other financial technologies have empowered SMEs to expand their operations and reach new customers. Companies like Flutterwave and Paga are making significant strides in this rapidly growing market. Like in Indonesia, during COVID-19 pandemic, digital platforms were used to deliver financial assistance to the vulnerable populations, ensuring that aid reached those in need promptly. Nigeria's fintech sector has attracted considerable foreign investment, making it one of the fastest-growing fintech markets in Africa. Investors are drawn by the large, youthful population and the potential for fintech to transform the financial landscape in the country. Digital payment systems and fintech platforms make it easier for businesses to pay taxes, increasing government revenue which can then be reinvested to set up digital infrastructure. The fintech boom has created numerous jobs in Nigeria, from software developers and data analysts to customer support roles and mobile money agents. This has provided employment opportunities, especially for the youth, in a country with high unemployment rates. Women entrepreneurs have seen a significant growth, having benefited from easier access to credit and digital payment solutions, enabling them to grow their businesses and achieve greater economic independence. While fintech has made significant strides in financial inclusion, there is still a digital divide in Nigeria, particularly in remote areas, with limited internet access. Nigeria must improve its infrastructure to manage this divide. The dragon's shadow: China's influence on fintech growth around the world cannot be denied. China's rise as a global manufacturing and technology powerhouse, with its excess of wealth, is having a profound impact on the fintech landscape in poor developing countries. Chinese tech giants are expanding their reach. Its technology companies are exporting their expertise. China's Belt and Road Initiative, BRI, includes projects related to energy generation and distribution, digital infrastructure, and other technology-related installations that are essential for fintech growth. With China's investment and loans in these areas, the BRI has created a more conducive environment for fintech development and long-term sustainability for participating countries.